Imagine you waking up tomorrow to this headline: Government abolishes personal income tax, effective immediately. For a second, it feels like the most popular policy announcement in Indian history. WhatsApp explodes, the market surges at open. Every salaried professional in every IT park, every bank, every hospital starts calculating what they get to keep. And then the real question actually begins: where does the government get the money? What happens to the schools, roads, defense? Does everyone actually benefit or only some people do? Does real estate get cheaper or expensive? Does the informal economy clean up or does it just get bigger? This, ladies and gentlemen, is a classic first principles simulation. Not an opinion on whether this should happen, a mechanical trace of what would happen if it actually did. One policy, one domino, let's count where they are falling. Now, before tracing the consequences, a question worth sitting with is: who actually pays personal income tax in India? The answer is more uncomfortable than most people actually realize. In the financial year 2024-25, approximately 9.19 crore Indians filed income tax returns out of the 144 crore of total population. That's roughly about 6.4% of the total population size. And of those fillers, a large share had zero tax liability after deductions. The actual number of individuals who paid any net income tax is estimated at somewhere between 4 and 5 crore, which is roughly 3% of the total country's population. 3%. The other 97%, which includes farmers, daily wage workers, street vendors, and small traders, already pay zero personal income tax because they earn below the exemption limit, or because they're in agriculture, which is constitutionally exempt, or because they're in the informal economy, which by definition doesn't file for personal income tax. Now, here's where the story gets interesting. If only 3% of the total population pays this tax, what exactly does the other 97% gain from this if it actually disappears tomorrow? The answer is almost nothing directly, but indirectly, that's where it gets complicated. In financial year 2024-25, personal income tax brought the central government about 12.9 lakh crore gross before refunds. Net of refunds closer to 10.5 lakh crores. To make that number feel real, India's total government revenue before borrowing was about 30.78 lakh crore. Personal income tax is almost 34% of it. The government already runs a deficit, spending 46.55 lakh crore while collecting only 30.78 lakh crore. That gap, which is about 15.77 lakh crore, was the fiscal deficit in the financial year 2024-25, which is equivalent to almost 4.8% of the total GDP of the country. Remove personal income tax overnight, and that gap almost doubles to somewhere between 25 and 27 lakh crores. That's over 8% of the total GDP. Levels India hasn't seen since the pandemic, and before that, since the balance of payment crisis that actually happened in 1991. Think of it like a household. You earn rupees 30 lakh a year and you spend 46 lakhs, and you already borrow 16 lakh every year to cover the difference. Then you lose one third of your salary tomorrow. What happens next defines everything else in this documentary. The government has exactly four ways to respond. Each one triggers its own chain reaction, and none of them, I repeat, none of them are comfortable. Day 1. The winners are visible and immediate. A software engineer in Bangalore earning about 20 lakh a year was paying roughly 3.5 to 4 lakh in income tax. That's now hers to keep. A 20% take home increase overnight. An investment banker earning about 50 lakh was paying north of 12 to 15 lakh in taxes. Gone. A senior doctor, a business owner, a mid level consultant, anyone in the formal economy with an income about 12 lakh per annum notices a real, immediate, pocketable change. But Hold on. Remember the 3%? The gains are entirely concentrated in the formal, urban, high income slice of India. The IT employee in Hyderabad and the auto rickshaw driver in Varanasi both wake up on day one and only one of them sees an actual difference. Now, watch what the formal sector winners do with the extra money because that's where the chain reaction actually starts. Economists call it the marginal propensity to consume, the fraction of extra income that gets spent rather than saved. For salaried Indians in the 15 to 50 lakh range, that number is actually very high. First order consumption goes up, which is your electronics, your vehicles, your dining, your travel. The 3% of the population who have actually gained through the income tax rebate are high spending households. Their combined consumption impact is much larger than their total 3% population share. Second order, businesses serving these folks actually expand. More restaurant covers, more flight seats, more premium housing inventory gets absorbed. Sectors linked to discretionary spendings actually massively benefit from this development. Third order, and this is where it gets counterintuitive. If everyone in the formal economy suddenly has 20% more purchasing power for the same goods, which are things like car, premium flats, doctor appointments, what exactly happened to the prices? They rise. The supply of a 2 BHK flat in Bangalore doesn't increase just because people have more money to spend on it. The supply of a good cardiologist doesn't double overnight. When more money changes the same quality and the quantity, prices adjust upwards. The benefits partially evaporates into inflation specifically for exactly the goods and services that the winners wanted to buy. This is the first hidden irony of the abolition. Some portion of the tax saving doesn't produce more purchasing power, it produces higher price tags. Back to the 12 to 13 lakh crore hole. The government has four real options and none of them are actually free. Option 1, borrow more, issue more government bonds. The problem, India's bond market actually runs on confidence. A sudden near doubling of the fiscal deficit triggers a ratings review. Foreign investors reconsider. Bond yields rise, meaning that the government now pays more interest on everything it owes. Interest payments already eat close to 24% of every rupee that the government of India actually spends. More borrowing actually means that more the percentage goes to servicing debt and less to roads, hospitals, and schools and developments that actually matter. There's also the crowding out effect. When the government borrows heavily, it competes with companies and the home buyers and the homemakers for the same pool of bank funds, pushing up the interest rate massively for every single person in that country and economy. Option B, raise GST. Take the country from an 18% goods and service tax structure towards a 22 to 25% GST tax structure. This is the most obvious replacement, but here is the critical mechanical point. GST is actually a consumption tax. Everyone pays for it. The software engineer and the auto rickshaw driver, the 97% who gain nothing from the abolition of the income tax, now pays higher GST on everything that they go on to buy. You've been handed a tax benefit to the top 3% and redistributing the cost of the remaining 97%. That is not some kind of a simplification, that's a regressive transfer, taking from the many to give to the few, dressing in the language of tax relief. Option C, corporate taxes. India cut corporate tax rates in 2019 from about 30% to about 22%, specifically to attract investments. Reversing that signals policy instability to every multinational company who's actually evaluating India as a manufacturing base. The investment climate cools down, and this directly goes on to affect the economy of the country. Option D, cut spending. Which program do you cut? The MG Narega, which supports close to 15 crore rural households, or defense during a period of active border tension, or subsidies on foods or fertilizers, gas that keeps the cost of living unbearable for the bottom 50%. Now, one thing is very clear, right? In practice, every government that has ever faced a sudden revenue collapse has done something, one of these versions, right? Or all four of them simultaneously. And we've seen it previously. And the cascades from each option overlap with the cascades from the other. Now, for the question most people find interesting, what happens to India's real estate market? This is where the intuition breaks down, right? The popular assumption is that when you abolish income tax and the motivation to generate black money generally falls. No, income to hide means no need to launder it through property, right? No income to hide generally means that there is no need to launder it through property, right? Cash transactions fall, price becomes transparent, and maybe even fall. Here's the mechanical problem with that logic. Most of the cash in Indian real estate isn't being hidden from income tax specifically. It's being hidden from stamp duty, from capital gains disclosure, from the gap between the government set circle rate and the actual market price, almost of all of which are state taxes and not income tax in particular. According to the 2024 Local Circles survey of 39,000 respondents, 2 out of 3 property buyers in the last 3 years paid some portion of their transaction in cash, and 26% paid more than half in cash. 8 years after the demonetization, which was specifically designed to break this cycle, cash in circulation has doubled, believe it or not, from about 17 lakh crores in the year 2016 to somewhere or upwards of 34 lakh crores in 2024. So the black money ecosystem in real estate is more deeply rooted than just income tax evasion, and that is something that we need to fundamentally understand and acknowledge. It persists because stamp duty arbitrage is profitable, not because the income tax exists. What income tax abolition does, specifically some kind of development in real estate, is capital gains tax on property sales disappear. Transaction becomes simpler. The legitimate side of the market likely to see a boost in activity. Demand from newly cash rich formal sector owner pushes price further up in some premium segments. Net effect on real estate is that higher activity, higher prices, partially cleaner transactions, not dramatically cleaner. The circle rate gap problem remains intact and is grounded into the roots and very difficult to solve just with a small income tax abolition development. Let's trace the people the documentary hasn't mentioned yet, right? The domestic worker who earns about 15,000 rupees a month, the construction laborer, the vegetable seller, the handloom weaver. They paid zero income tax before this policy. They pay zero income tax after. On day one, nothing actually changes for them. Now, follow the chain. The government chooses option B, which is rising GST to fill the hole. The price of everything they buy rises: cooking oil, detergent, mobile recharges, construction materials that pass costs through all landlords. Or the government chooses option A, maybe, which is borrow more. Interest rates edge up. Their village's banking lending rate for a Kisan credit card rises. Their informal loan from the local money lender now costs more because the entire credit ecosystem has actually repriced itself after this development. Or the government can go ahead and just cut spendings, and the subsidized gas cylinder now costs more. The public hospital gets less funding. The mn the Mahatma Gandhi employment scheme, the MN Rega, right? Wages get paid more slowly than they are getting paid now. So the 97% of the people, they don't actually gain anything from the policy, but they are not immune from the consequences either. This is the mechanism most invisible, which is this is one of the mechanisms which is the most invisible in the political debate. Tax changes that appear to target only the wealthy can still transmit shock to the poor, not through direct taxation but through fiscal responses, inflation, and the secondary effects of the public services. The person with the salary slip feels the benefit, the person without one feels the adjustment when it is made in the economy. And the adjustment, ladies and gentlemen, is something that has to happen, otherwise there is no alternative. One genuinely positive thing about this whole development is that to an extent formalization might improve, and this is again debatable, but here's what I feel, right? One of the reasons small business owners stay informal is to avoid compliance cost and the paperwork of income tax. Even if their actual tax liability is modest, when that compliance burden disappears, the barrier to formal registration actually falls. A freelancer architect who was doing all her work in cash, because why invite income tax scrutiny, no longer actually has that concern. This is real and this is why it matters. More formal registration means more GST filings and more credit access, better data for the government to plan stuff and do developments in the future. But the effect also has a ceiling. The informal economy accounts for an estimated 45 to 50% of India's GDP and over 90% of its employment. The primary reason for that scale isn't some kind of an income tax, it's actually GST registration requirement, labor law compliance, the cost of formal accounting, the complexity of contracts, and historically a lack of trust that formal systems deliver value back. Abolishing income tax removes one layer of that friction. It doesn't remove the deepest layers. The bulk of the informal economy remains not because of income tax, but for the reasons income tax abolition can't actually address. The truly interesting effects take place mostly within years, right? And we're going to see an illustration of that. Let's say in 5 years, if the revenue hole was patched with higher GST, a pattern emerges. India's tax system has shifted from taxing income to taxing consumption. This has a technical name, consumption based taxation, and it has a known structural property, right? It's pro cyclical. That is, when the economy is doing well, people spend more and more taxes roll in. And when there's a recession, spending collapses and so does the government's revenue exactly when the government needs to spend more. Income tax is more counter cyclical. When income falls, collection falls, but not as sharply as consumption does. Right? That is the illustration. In year 5, the incentive structure for companies has changed. Salary and take home pay are now perfectly aligned, and employers can negotiate harder on gross salary, knowing that the employee gets to keep all of it. Over time, the labor market's bargaining power might actually shift, and this is a positive development, like it should be, and part of the reasons why I'm highlighting this in the video. In year 10, there is a subtle loss. The government no longer has income tax filing as a window into individual economic behavior. Income tax returns are arguably one of the best databases India has on formal income sectors spendings, right? Which is giving more insights and details about their spending patterns and wealth. That data goes on to completely disappear and the state becomes partially blind. And in year 10, the deepest question, what is the social contract? Democratic governments derive legitimacy partly from the argument that you pay taxes and in return the state provides roads, education, healthcare, security. If the formal sector stops paying income tax but receive diminished public services because the government has less revenue, the implicit deal has actually fundamentally changed and flipped. Abolishing personal income tax in India immediately creates a revenue gap of roughly 12 to 13 lakh crore, nearly equal to the existing fiscal deficit in the country. Every path to filing that gap carries its own chain reaction. The direct winners are the 3 to 5 crore formal sector earners, predominantly urban, predominantly in the upper income bracket. They receive a real, immediate, and a significant income boost. The indirect effects, however, spread far beyond the 3%. Higher government borrowings pushes up the interest rate for everyone who actually goes on to borrow. Higher GST shifts the tax burden to consumption, which is regressive. Inflation in premium goods erodes some of the windfall, and public services funded by income tax revenue face pressure to operate. Real estate becomes more active but not meaningfully cleaner. But because the cash economy in property is driven more by stamp duty arbitrage than income tax itself, the informal economy sees modest improvement in formalization and not a very big transformation, right? That is what we also discussed previously. The long run structural risk is that the tax base shifts from relative progressive direct taxing to relatively regressive indirect taxing, which is not automatically a bad thing, but it does redistribute who bears the cost of the government quietly without a vote. Does that mean abolishing income tax is wrong? That is actually the wrong question to ask. Every economy makes trade offs about where to collect revenue, and it's highly debatable across countries depending upon the population, culture, and the constitution. Consumption taxes work well in some contexts, right? Mostly in Gulf states, most of the Gulf states actually use them. Though they have oil revenues to backstop them, they still go on to use consumption taxes. Hong Kong runs a low flat income tax and high land valuation taxes. Singapore taxes aggressively on property transactions, and there are real options. But the question that is worth asking isn't, should India try to abolish income tax? It is actually, if you remove this one lever, what precise lever replaces it and who bears that replacement cost? Answer that clearly and you can evaluate the trade off. Leave it unanswered and you haven't described a policy, you have just described a wish, which in real life to execute is absolutely hilarious and makes zero logical sense. The economy, ladies and gentlemen, is a system. Pull one wire and every other wire feels it. The documentary traced one wire, the others are still connected.